Well, Dr. Jim Thorne, one of our favorite guys to listen to over at Wellington, has got his December Market Insights out. These Market Insights are always a great read, and they always kind of follow a theme. What were some of the things that you found in that article that we just launched yesterday, Dave?
I would say probably it's just the resilience of the markets. The skepticism has been there for years, like the last couple of years. It's just, inflation's high, debt is high, price earnings ratio is high. All of these things that are high, the market should have died a death a long time ago. So I think it's about, his comments are about resilience and the fact that companies are continually reinventing themselves. They're adopting technology at a higher rate. A lot of good things are happening corporate wise, even though we have all these headwinds, that type thing. What'd you get out of it?
Same sort of thing about, if you'd have listened to the mainstream media, you probably would have sold all of your positions and had missed out on a tremendous market run. We're in the middle of a bull market that started a year ago. And back then, if you look back a year and look at what the news articles were and continuing through the year, and I think that's what he's summarizing here in December, is saying, if you'd have stayed on the sidelines, you'd have missed out on a lot of gains right now.
Yeah. Yeah, it somehow feels that when you think about what you read in the media, that it's like they have their money invested the way they do, but the alarm's being sounded. So everybody else goes and bails out, but the people who write it, they never bailed out. Like it's good news, but it doesn't mean anything. Sometimes it's noise.
Yeah. Yeah. So that's kind of the, I guess, overall theme of the article. There's a few other points in there that Jim makes. One of the ones he touches on is inflation. We've went through this period of high interest rates, which are now being cut and pulled back. Basically, that indicates that inflation is coming down. Jim's mentioning in this article that he's always believed that inflation most recently has been driven by pandemic spending and, supply chain issues that we had. So it's interesting
and
to
government money.
Yes.
Yeah. Flooding the market. Yeah.
Yeah. So that's interesting to see that. I guess, is it true, that what drove inflation higher, and is that what caused interest rates to rise? I guess history will, we'll figure that out.
I mean, right now it's starting to look like it a bit. I mean, a year ago, people were still arguing, no, that's it's in the wage growth, it's in all these other reasonings. But I think it's slowly starting to play out that was incorrect, the correct position, that it was pandemic related. It was too much free money in everybody's pockets and everybody chasing the same good that wasn't as available because of supply issues. So he did make another comment about inflation, which I found interesting, that they're trying to get down to the real rate, 2.75. But, his comment was, if your goal economically is to have a 2% inflation rate, then interest rates need to be below that in order to have people borrow money to grow the economy. If your interest rates are over that, then people aren't borrowing as much. You're not going to get any inflation if people are not actively participating in the growth of an economy.
Right. Yeah, it's interesting to read his talks on the inflation and interest rate changes, because part of it is what he feels might move into a deflationary period of time. So what we're not seeing yet is the effects of these high interest rates. They lag, I guess. The cause, or not the cause, but the effects of high interest rates haven't been seen yet. Yeah. So even though interest rates are coming down, we're not yet seeing the effects of a high interest rate environment. And I guess that's one of the things that makes Jim a bit nervous about where markets are going, because we could see 6 to 18 months from now the effects of high interest rates.
Yeah. Oh, and coupled with the fact that earnings ratios are getting quite high, and I mean everything. It's almost like a trifecta of things that are gonna come together. You've got maybe some austerity measures. You've got the effects of high interest rates that are going to end up coming through, and you have a flying stock market where your valuations are quite high. And so I expect, it's going to be a volatile year, and not that the bull market comes to a grinding halt, but it's going to show, we're going to see some bear fangs a few times throughout the year next year, I think. And maybe at some point, a more prolonged pullback. Will it get to bear territory? Who knows? But it's going to be a bit of a year. I think that flows into the next thing is, where do you position? And that was kind of some of his comments in the article.
Mm-hmm. Yeah, and he's saying, energy is not really the place to be with a Trump victory down in the States and their interest in being so totally self-sufficient. It's what's the comment? Drill, baby, drill, which of course drives down the price of oil for other OPEC nations. So energy, he's saying, probably not the best place to be, but where is he pointing everybody?
Yeah, I think he's saying you got to be with innovation, with where the growth is. If you get deflationary pressure, which, oil and gas, once again, energy prices come down, that's impacts across the board. We talk about it all the time that, carbon tax, because it's tied to energy, causes inflationary problems. So when you decrease the cost of energy, it's more money in everybody's pocketbooks. But with that, industries that maybe have a bit of a protected field, did they get into, say, AI? Adopters, did they gain market share? So therefore they're protecting their earnings. If you get deflationary pressures, that forces everybody to lower prices, which means the margins, which means the ability for these shares to continue to grow get reduced a bit. So there's kind of a lot of different things moving it out. So I think it was growth, really much Bitcoin, gold, very protectionary.
Yeah, technology stuff. And it's technology that's driven the markets for a lot of years now. And he doesn't seem to think that that's going to change much. That's going to continue to be the driver in 2025. And he says it's another positive year for the stock markets in 2025. It's not a bear market. We're still going on with our bullish trend. So if you want to learn more about this newsletter, it's a good one to read. By all means, check it out at our newsroom at towerwealth.com.
Awesome.